We've all heard it a million times. Debt is bad. Avoid it like the plague. And you know what? Most of the time, that's good advice. Credit cards, car loans, payday loans, these are all designed to trap you in a cycle of payments and interest. But what if I told you there's a type of debt that can actually help you build wealth? Now, I'm not talking about get-rich-quick schemes or risky investments. I'm talking about a strategic approach to borrowing that, when done right, can amplify your returns and help you reach your financial goals faster. It's called borrowing to invest, and while it's not for everyone, it's a strategy worth understanding. Before we dive in, let me be clear. This strategy is not about getting rich overnight. It's about using debt responsibly and strategically to potentially accelerate your long-term financial growth. Remember, every investment comes with risks, and borrowing to invest amplifies both the potential gains and losses. Before you even think about borrowing a dime to invest, you need to have your financial house in order. This means being debt-free except for your mortgage, having an emergency fund of 3 to 6 months of living expenses, and investing consistently in your 401k or Roth IRA. This strategy is for long-term investors, not day traders. You need to be comfortable with market fluctuations and understand that investing is a marathon, not a sprint. If you panic and sell your investments when the market dips, you could end up losing more money than you borrowed in the first place. Finally, remember that this is not about getting rich quickly. It's about using debt as a tool to potentially enhance your returns over the long haul. Now let's talk about the wrong way to borrow for investing margin loans. These loans are offered by brokers and allow you to borrow money against the value of your investments. Sounds tempting, right? Here's the catch: margin loans come with high interest rates and can magnify your losses. Imagine the market takes a downturn and the value of your investments plummets. Suddenly, you get a margin call from your broker, demanding you deposit more money to cover your losses. If you can't come up with the cash, they can sell your investments at a loss, leaving you in a deeper hole than you started. Trust me, folks, margin loans are a recipe for disaster. They're best avoided at all costs. So, if margin loans are a no-go, what's the right way to borrow for investing? 2 words: term loans and lines of credit. These financial tools can be game changers for investors looking to leverage their capital without the high risks associated with margin loans. These loans typically offer lower interest rates than margin loans and give you more flexibility in managing your debt. This means you can plan your investments more strategically and avoid the pitfalls of high-interest debt. A term loan is a lump sum of money that you borrow and repay over a fixed period, usually with fixed interest rates. This can provide a sense of stability and predictability in your financial planning. This can be a good option if you have a specific investment in mind, like buying a rental property or investing in a diversified portfolio of stocks. It allows you to allocate a set amount of funds towards a targeted goal. A line of credit, on the other hand, is like a credit card with a revolving balance. It offers more flexibility, as you can draw funds as needed and repay them at your convenience. You can borrow up to a certain amount and only pay interest on the amount you use. This can be particularly useful for managing cash flow or seizing investment opportunities as they arise. This can be helpful if you want to have access to cash for opportunistic investments or to cover unexpected expenses. It provides a financial cushion that can be invaluable in volatile markets. Remember, the key is to shop around for the best interest rates and terms. Different lenders offer different packages, so it's crucial to do your homework. Don't be afraid to negotiate with lenders to get the best possible deal. A little bit of effort can save you a lot of money in the long run, making your investments even more profitable. Section 5. Calculating your potential returns versus interest. Now let's talk numbers. Understanding the relationship between returns and interest is crucial for making informed financial decisions. Whether you're a seasoned investor or just starting out, grasping this concept can significantly impact your financial future. The success of borrowing to invest hinges on one crucial factor. Your return on investment needs to outpace the interest you're paying on the loan. This means that the money you earn from your investments should be more than what you owe in interest. If not, you could end up losing money instead of making a profit. Let's look at a couple of scenarios. Scenario 1. Positive returns. This is the ideal situation where your investments perform well. You borrow $10,000 at a 5% interest rate and invest it in a diversified portfolio of stocks that earns an average annual return of 8%. This means your investments are growing faster than the interest accumulating on your loan. After 5 years, your investment would grow to approximately $14,693, showing a significant increase in value. While you would have paid around $2,500 in interest, this is the cost of borrowing the money, but it's outweighed by the gains from your investment. That's a net gain of about $2,193 even after deducting the interest. Scenario 2. Negative returns. This is a less favorable outcome but important to consider. Now, let's say the market doesn't cooperate and your investments only earn an average annual return of 3%. This is a realistic scenario that can happen due to market volatility. After 5 years, your investment would be worth around $11,593, which is significantly less than in the positive scenario. While your interest payments would still total about $2,500, the interest cost remains the same, but your returns are much lower. This means you'd only make a net gain of around $900. It's still a gain, but much smaller and less impactful. These are just simplified examples, and your actual returns will vary depending on factors like market conditions, your investment choices, and the interest rate on your loan. It's essential to consider these variables when planning your investment strategy. Always remember, investing comes with risks, and it's crucial to do thorough research or consult with a financial advisor to make informed decisions. And your actual returns will vary depending on factors like market conditions, your investment choices, and the interest rate on your loan. By understanding these elements, you can better navigate the complexities of investing and borrowing. Section 6. Boosting your returns, the leverage advantage. One of the main advantages of borrowing to invest is leverage. Leverage is simply using borrowed money to increase your potential returns. Let's say you have $10,000 to invest, and you're confident that a particular stock will increase in value. Instead of investing just your $10,000, you could borrow an additional $10,000 at a 5% interest rate, giving you a total of $20,000 to invest. If the stock doubles in value, your investment would grow to $40,000. After repaying the loan and interest, you'd be left with a much larger profit than if you had only invested your own money. However, keep in mind that leverage magnifies both profits and losses. If the stock had decreased in value by 50%, you would have lost $10,000 of your own money, plus the interest on the loan. Section 7. Navigating inflation with debt. Inflation is a silent wealth killer. It creeps up slowly, often unnoticed, but its effects can be devastating over time. It erodes the purchasing power of your money over time, meaning that the same amount of money buys less and less as prices rise. Everyday essentials like groceries, fuel, and housing become more expensive, stretching your budget thinner and thinner. While inflation is a natural part of any healthy economy, it can be a major obstacle to building long-term wealth. The challenge is to find ways to protect and grow your assets despite this constant erosion. Here's where borrowing to invest can play a role. By strategically using debt, you can potentially outpace inflation and grow your wealth. When you take out a loan, you're essentially betting that your returns on investment will outpace the rate of inflation. This approach requires careful planning and a good understanding of both the risks and rewards involved. If your investments grow at a faster rate than inflation, you're effectively repaying the loan with cheaper dollars. This means that the real value of the money you owe decreases over time. For example, let's say you borrow $10,000 at a 5% interest rate to invest in an asset that generates a 7% return. Over time, the value of your investment grows, while the real cost of your debt diminishes. The current inflation rate is 3%. This rate is crucial to consider because it directly impacts the real value of your returns. This means that your real rate of return, the return on your investment after accounting for inflation, is 4%. This is the true measure of your investment's performance. In this scenario, you're effectively paying back the loan with dollars that are losing value at a slower rate than your investments are growing. This strategy can be a powerful tool in your financial arsenal, helping you to navigate the challenges of inflation and build lasting wealth. Section 8. The importance of planning and professional advice. Borrowing to invest is not a decision to be taken lightly. It requires careful planning, a thorough understanding of your risk tolerance, and a solid financial foundation. Before you even consider this strategy, sit down and create a detailed financial plan. This plan should outline your financial goals, your investment timeline, and your strategy for managing your debt. It's also crucial to consult with a qualified financial advisor. A good advisor can help you assess your risk tolerance, develop a personalized investment strategy, and guide you through the process of borrowing to invest safely and responsibly. Remember, every investment comes with risks, and borrowing to invest amplifies both the potential gains and losses. It's essential to approach this strategy with caution and to never invest more than you can afford to lose. Section 9. Borrowing to invest. A calculated risk with potential rewards. Borrowing to invest is not for the faint of heart. It's a strategy that requires careful planning, a long-term perspective, and a healthy tolerance for risk. However, for those who are willing to do their homework and approach it strategically, borrowing to invest can be a powerful tool for building wealth and reaching financial goals faster. Remember, the key is to use debt responsibly, invest in assets that align with your risk tolerance and investment timeline, and always prioritize paying down your debts on time and in full. If you're considering borrowing to invest, take your time, do your research, and seek professional advice to determine if this strategy is right for you. With the right approach, you can potentially harness the power of debt to fuel your financial future.